The age-old debate of renting versus buying is even more important today with the increase in interest rate and rent all over the world. The equation is actually quite simple. Is it more or less expensive to rent versus buying a given house? I live in Tokyo, so all my information is going to be based on local data, but the principles are going to work regardless of where you live. Let's say you're renting a house that costs 50 million yen and you're paying 200,000 Japanese yen a month. By the way, everything is converted in dollars at the bottom of the screen for your convenience. Knowing that you only pay the rent, but to own, you'll need to pay property tax, maintenance, as well as finance the house. Which one is the most expensive on a monthly basis? My name is Johan from Economia. Welcome back to the channel. Let's get started. When you rent, it's pretty easy. You're giving your monthly rent to your landlord and that's it. You have renter's insurance, but I'm going to put that on the side. So what's really important to understand is the cost of ownership when you actually buy the house. It's divided into three parts: property tax, maintenance and insurance, and financing the house. This part is the most difficult, so I'll leave it for the end. Let's start with the property tax. It's basically what you owe the state for living where you live. In Tokyo, you pay the house and the land property tax separately. They are about 3 to 1.5% range. It depends on how and what kind of use you have for the land and for the house. For simplification, we're gonna take a total of 2%. For our 50 million Japanese house, 2% comes down to 1 million yen a year. Now, let's talk about maintenance and insurance. Insurance varies a lot, so I'm going to take it out of the equation for the time being because it depends on the coverage you have. For maintenance, usually people say you should take 1% of the value of the house per year to calculate your maintenance cost. That's what we're going to do. Our house is 50 million Japanese yen. We take 1%, we are 500,000 Japanese yen a year. Now, let's go into the financing. This one is a bit more difficult. Usually, when you finance, you have a down payment and the rest is finance. In our case, we're going to take a 20% down payment and finance the remainder. 50 million yen, 20% would be 10 million yen. That's your down payment. The remaining 40 million is going to be financed. Now, we have to talk about opportunity cost. Opportunity cost is the cost of a lost opportunity. In our case, if you're doing a 10 million yen down payment, what would have happened if you had taken those 10 million yen and invested them instead? What would be the difference in the money you would get compared to the money you wouldn't get because you are putting it as a down payment? The easy one is taking the stock market because we have a lot of data. So let's imagine you take your 10 million yen down payment, but you don't use it as a down payment. You're investing on the stock market. Then you're going to take an index to see about the return. If you're in the US, it's going to be the S&P 500, for example. I'm going to base everything on Japan. So let's look at the Japanese stock market. The past 30 years, the Japanese stock market return in dividend reinvested about 4.6% a year. I know it's quite low, but it's getting better. And now we need to know how much money we are making with our house when we invest our 10 million in there, right? In Tokyo, on average, the increase is 3.3% a year. So now we know that the stock market gives us 4.6%, the house increases in value by 3.3%. We make the difference and we see 1.3%. This is our opportunity cost. This is the difference. So our 10 million yen has an opportunity cost of 1.3% or 130,000 Japanese yen. The other part is the 40 million yen that we need to finance through a bank and pay interest on. The average interest rate for a 35-year mortgage with fixed interest rate is 3% in Japan. So 40 million times 3% gives us 1.2 million yen a year paid in interest. So now we take those 1.2 million yen plus the 130,000 that we had as our opportunity cost, and that's the total cost of financing the house for 1 year. So if I summarize the cost of ownership in total, we start with the property tax that we set at 2%. Then we have the maintenance cost at 1%. Then the cost of financing, and we come down to 2.66%. You add all the cost for a total of 2.8 million yen, then you divide it by the purchasing price of 50 million yen, and that gives you 5.66%, which is a very rough percentage that you can use to calculate the monthly cost of ownership of the house. Then you can make a comparison apple to apple between your monthly rent and the monthly cost of ownership. Let's see how it works. So remember, the cost of purchasing the house was 50 million Japanese yen, and we know that on average the cost of ownership is 5.66%. So we make a calculation and we go back to 2.83 million yen. That's our annual cost of ownership divided by 12 to get a monthly cost. And the monthly cost of owning this house is 235,833 Japanese yen. And now we have an amount that permits us to make a comparison month to month between renting and owning. For this specific house that was renting for 200,000 yen a month compared to owning that house, which is 235,000 yen a month, you're better off renting it if you are taking into account only the financial aspects. And before we go to other considerations, I know it's a lot of numbers that I throw at you and you are in a different situation, maybe in a different country. So I'm linking down below a Google spreadsheet that's been done by a fellow YouTuber called Humphrey. He has made all the calculations. It's really well done. There's no reason for me to making another one. So you'll have directly all the details down below and you can make your calculation and see what works for you. I hope it's really useful. If it is, don't hesitate to let me know in the comment or give a like. Now let's go to the other considerations that are not just financial about the difference between renting and buying. First, we are emotional animals. Sometimes we do things that makes absolutely no logical sense. For a reason we don't know. Sometimes you go buy a very expensive coffee, knowing that it makes no sense. Or maybe, rather than investing your 10 million yen down payment on the stock market and getting good money out of it, you go buy a fancy thing. It's completely crazy. But hey, we're emotional animals. So that's the first point. The second point is the cost of capital can change over time. By that I mean, what we've seen in the past year and a half, interest rate can go up very much, 500 basis points in a year and a half. That's absolutely insane. And the rent as well can go up. So that's completely changed the equation. Also, your mortgage can become longer or shorter. A lot of things can change with the financial institution that you've been borrowing money against. There is another thing that we need to think about. When you have a mortgage, you have what's called a schedule of amortization. Basically, as you can see on screen, at the beginning you mainly pay interest, and as time goes by you start repaying the capital. Basically, as you repay the capital, more and more of the house belongs to you. In a way, you are a bit saving money. Another one is the fact that a house or an apartment is a tangible asset. When you're done repaying the loan, it's yours. It's completely yours to retire or do whatever you want with it. And as we've seen in the US and in Japan, where I'm located, and other places, over time, real estate appreciates. So you might end up after 30 or 35 years with an asset that has tremendously increased in value. You can still live there or sell it out and go live somewhere else. And of course, when you have a mortgage, there are usually tax benefits associated to it. Usually, you can deduct the interest payment from your taxable income by then reducing your taxable income and saving in taxes. Or at least, I know it works in the US, I know it works in France, it works in Japan where I am. It might not be exactly the case for you, but you should talk to a specialist, a tax accountant, because it's worth checking if you can reduce your taxable income. There are more things to take into consideration when you are thinking about buying versus renting. First, you have a predictable payment schedule because you know exactly every month how much you're going to pay and repay for your mortgage. As we've seen, rents can change all of a sudden and your landlord can jack up the price by 20, 30, 50%. You never know. You have more control over the home. You can change, you can repay and do things that you can't do when you're renting. There's also an added sense of security. You can't get evicted as long as you pay your taxes and you have a place to retire in your old days. That's not negligible. Then there's inflation advantage. This one is quite counterintuitive, but hold on with me. When you're repaying $2,000 or $3,000 a month, then over time, there's inflation going at 4 or 5% or 2%, whatever it is. Over time, the value of money diminishes. Basically, for you, you are paying relatively less money over time. For example, if you had 30 years ago a mortgage that was $1,000 and you would be paying it still $1,000 today. $1,000 mortgage today is a pretty good mortgage. You see what I mean? And finally, there's appreciation. I mentioned it before, but a house, a 50 million yen house today actually wasn't that much money 30 years ago, as you can see on screen. This is, again, a very good asset that appreciates over time, and once you've done repaying your mortgage, there's a lot of things you can do with all that money. Either you keep it or selling or invest it. And of course, there's a sense of accomplishment of being able to buy a house, repay it, and give it to your loved ones afterwards. This is so important and goes way beyond every financial consideration. At least, that's the case for me. Now, we should talk about renting, because renting has also its advantages besides paying a monthly rent. Flexibility. You can move to another place tomorrow if you're remote working or you want to go live on the countryside. You don't pay tax, you don't pay maintenance or down payments. This is really good. You can invest all that money. And some buildings in big cities have a lot of amenities. You have a pool, you have a valet, you have a place to do barbecue and entertain. This could be interesting, at least at the beginning of your professional life. In the renting versus owning debate, now you have all the information you need to be able to run the numbers and make a decision on your own. That's actually what I did a few months back when I bought my own house in Tokyo. I made a video about it and you can check it out here if it's not done yet. If you like this video or learned something, please give it a like. Do not hesitate to subscribe for more videos to come, and leave a comment down below if you like this video. I'm sure you did because you're still here. Thank you very much, and until next time, goodbye!